Welcome to Stockcharts TV. I'm John Kosar of Asbury Research. Today I want to talk to you about a very unique environment that the U.S. stock market is in the midst of right now, because I believe that it could be the early signal towards a significant bearish market reversal over the next, I would say, over the next 3 to 6 weeks. So we're going to begin today by looking at Nvidia. Nvidia just had their earnings reported after the close yesterday. It's down a little bit today, but Nvidia is still the poster boy stock. It's still where, when people look at the move that we've had this year that was AI driven, it's really the poster boy for that. And I think it's got a lot of, and it's also one of the largest stocks, obviously. So it's got a lot of market cap that's pushing the rest of the market. So up on top here, we have Nvidia, 200-day moving average, 50-day moving average, orange and blue. We can see the trend, the major trend is up. It's above the 200. And we're going back and forth through the 50-day moving average. What that tells me is that the minor trend is in flux. We had a strong minor trend here really from April all the way through middle of July. And then we broke down underneath the 50-day, and now we're back above it, and we're testing it again. Here's the most important part of this chart. I want to know what Nvidia is doing versus the broad market. Because it's been a leader all year, I want to see if it's leading. So what we've got down here is a relative performance chart that corresponds with the chart up top, but we're looking at Nvidia versus the S&P 500. We're actually looking at SPY here, but it's the S&P 500. And look what happened here. On August the 15th, Nvidia started to outperform SPY. And what happened? Nvidia started to move higher. It started to take a run at its old highs. Look what's happening now. As of the last day or so, it's starting to underperform again on a 63-day basis, which is a business quarter. The longer time that Nvidia spends underneath the 63-day moving average, the more vulnerable the stock is going to be to roll back through the 50-day moving average downward and maybe cause a little commotion in terms of spooking the market. The next thing we're going to look at is we're going to go over here to Asbury Research, and we're going to look at our Asbury 6. Most of you that have followed me on stock charts over the years know that the Asbury 6 is our daily model that tells us the internal health of the market. So this is through yesterday, 8/28, and all 6 are green, all 6 of these metrics. We've got the rate of change. We have the relative performance between stocks and high yield bonds. We have investor asset flows going into SPY. We have volatility, trading volume, and breadth. The reason we look at this is so we don't get drawn into chasing the tail of the S&P 500 when it's up 50 in the morning and down 50 at night. This tells us, if you look at this as the 6 cylinders on a car, this tells us if we're hitting on all 6 cylinders. Right now we are. So that means for the time being, there's no reason to look for any weakness or to look to change your positioning in the market because the internals are strong. The next thing we're going to look at is going to be Microsoft. So we're going to go back up here to stock charts, and we're going to move to Microsoft. Microsoft is big, is very influential for obvious reasons. I think it's the second largest stock after Apple in terms of market cap. It's been sitting on major support here since the beginning of August. This is August 5th down here. This is the low. Went through the 200-day moving average in orange for a day. It's been trying to stay up above it ever since. As long as it does, the major uptrend, I think, which dates all the way back to the beginning of the year, is still intact. If it breaks that, now we've got problems. But again, relative performance is a big deal to us at Asbury. It tells us a lot about the internal condition. And Microsoft is a leader, right? So we want to see this outperforming the S&P. You can see it's been underperforming the S&P since the middle of July. This is relative performance down here of Microsoft versus SPY. The green line is the 63-day moving average because we want to see to the quarter if it's outperforming or underperforming the market. It's underperforming. That tells me that this has a more likely chance up top for Microsoft to actually be weaker and break the 200-day because it's a market leader and it's actually been underperforming the market for about the past month. The next thing we're going to look at is another relationship chart, another relative performance chart, and we're going to go to our next chart here. This is NDX. This is a Nasdaq 100. It's the smaller and larger capitalization of both of the Nasdaq. So what we've got here on the upside, or up on the top panel rather, major uptrend because it's above the 200-day moving average. It came down and tested it on August the 5th, took off like a shot. A lot of new buying came back in, and now we're trying to hold the 50-day moving average, which is the minor trend proxy. But look what's going on underneath here in the lower panel. NDX has been underperforming SPY since July the 24th. What does that mean? It means that the leadership that we had at the beginning of the year that dragged the market higher with the AI stocks, that's gone away for right now. Since, again, for about a month, it's been underperforming the S&P. This is all of the large cap stocks, right? All of the ones that were in the headlines all year. It's underperforming. The next one we're going to look at is the other typical leader during a bull market, during an uptrending market, let's call it. And what we're looking at now is the SOX index, Phillips Semiconductor Index. Semiconductors typically lead tech. Tech typically leads the broad market. Look what's happening. We came down and tested its 200-day moving average. August 5th was that big day. And now we're trying to get back up above the 50-day moving average up in the upper panel to try to reestablish the minor trend. But look what's going on underneath here. Since July 23rd, it's been underperforming the S&P 500. That's a bad sign. What does that mean? It means the normal market leaders in a normal uptrend, they're underperforming. The next one we're going to look at is the defensive index to see what that's doing and if it kind of corroborates what we're seeing here. So same chart, but now we're looking at DIA. DIA is the Dow 30, the ETF for the Dow 30. We've got the 200 and the 50-day moving average. It's up above both, right? So the minor trend, the major trend are up. Look what's going on down here in the relative performance chart. The Dow has been outperforming SPY since that same time period, July the 24th. And it came back and retested it right here about a week ago, and now it's starting to outperform again. If you took away the chart of the S&P 500, which we're going to look at in just a minute, and just showed me these three charts and asked me what kind of a market we're in, I'd say we're probably either in a sideways trend or we're in some kind of a weakening trend. That's really not the case, but the way these three charts are aligned, they're aligned for a market that is going into a defensive mode, buying the sure-footed Dow and staying away from the racehorses, so to speak, which are the SOX and the NDX. The next thing we're going to do, we're going to move back over to Asbury, AsburyResearch.com just for a second, and I want to look at sector rotation because right now the relative performance charts are showing me that the market is not acting like you would expect it to be in a normal bull market. So I want to see where the assets are going as they circle around the 11 sector spiders. This is our SEAF model, Sector ETF Asset Flows. It's an acronym. And what it does is it measures the velocity of assets that are moving around the 11 sector spiders. So we have a scoring system. I'm not going to go into that now, but these are the highest scoring, the ones with the lowest numbers in terms of the ranking. Those are the best scores. That means the money is moving into those places the fastest. And the red ones down at the bottom, it's moving out of those places the fastest. So look what's happening here. The two strongest ones, according to our model, are both defensive sectors. We got the utility sector, and then we also have consumer staples. Those typically outperform when the market's going down. Look at what we have on the other side. The second and third weakest scores, worst scores according to our model, are in technology and also in consumer discretionary. Those are sectors that typically do well when the market is excited and it's at new highs, the way we are right now. So now I'm going to move back again into stock charts, and I want to see what the S&P 500 looks like. We want to know where the levels are here, where if the market starts to turn, I want to know where that is. I want to know where the hot spots are on the chart. So this is a really simple chart, S&P 500 daily. We have 3 different moving averages on there. We've got a 21-day, which is a business month. We've got a 50-day moving average, which is the minor trend, and the 200-day, which is the major trend. 5,500 is where the 50-day is. 5472 is where the 21-day or the monthly trend is. If we break through there, especially if we get a switch to negative in the Asbury 6, that would mean 4 of those 6 metrics would have to turn red. Everything is positive right now. We just looked at that. But that's the hot spot that I think you have to pay attention to. The next thing we're going to do, which is kind of a cool feature here, is we're going to look at seasonality in the Qs, which is the ETF that tracks the NDX. And look what happens here. We have a strong July, strongest of the year. These are the 12 months of the year in the Qs going back a decade. So we have a little bit of weakness in August, and then we have the weakest month of the year in September. And then we have modest rebound in October. I could tell you by understanding what the weekly data looks like that's usually in the second 2 weeks of October. So basically seasonality, in terms of seasonality, we are weak in the Nasdaq, and all these markets generally, or all these indexes generally go up and down together. So there's a seasonal tendency for the market to be weak in September and through the first part of October, and we're just getting into that now. The last chart I want to show you is more of a trigger. I want to know, so we know the Asbury 6 is going to tell us when the market is becoming internally weak. I want to watch for more indications that there's going to be weakness. So we're going to go back to our bar charts, and we're going to look at another relationship. This is SPY, which is the S&P 500, of course, versus AG, which is the aggregate bond index ETF. We've got SPY up top with its 250-day moving average in blue and orange, just like the rest of the charts were. Down here is the daily relative performance of SPY versus AG. When SPY is outperforming AG, meaning when stocks are outperforming bonds, that's typically when there's an appetite for risk and the stock market likes that and goes higher. Look at this entire period. This is November 3rd, down here, right at the beginning of November. This is July 31st here. That's when SPY first started to outperform AG on a 63-day basis. We got this really strong move higher. Then on the 31st of last month, July, just almost exactly 1 month ago, SPY started underperforming AG. Stocks were underperforming bonds. That's an indication the market's becoming fearful, and look what happened to the S&P 500. Got relatively close to its 200-day moving average. So look where it is now. SPY has outperformed, but not by enough to get back up above the 63-day moving average. It's been negotiating it for about a week. So basically what we're looking for here is if SPY starts underperforming AG, if you notice stocks are underperforming bonds, that's an indication that these warning signals that we're seeing on our CEF model and in the relative performance charts with the Dow and the SOX index and the NDX, that's starting to materialize into tangible weakness that we can see on the chart. So watch that support level in the S&P 500. Keep an eye on the relationship between SPY and AG. If you have access to the Asbury 6, pay a lot of attention to when it starts to turn red again. And that's going to give me an indication that it is time to start putting my defense on the field, protecting some of the great profits that we've had so far this year. So that's it for today. I hope that gives you a little bit of an understanding of how we look at markets and some of the potential dangers that we see in the markets right now. For more information about us, you can visit asburyresearch.com. And thanks for watching. We'll see you at the next one.